So the word unprecedented is used too much in our society. We use it as a throwaway term. But what we're looking at the present time is genuinely unprecedented. This is an unprecedented health event. Government's attacking this full on, and you can see the impact in society everywhere that you look. I don't have to tell you what those impacts look for in employment. The government's trying to put the economy into hibernation and then slowly open it up again as COVID-19 effects start to pass. Those impacts are swift and severe. There's also been a direct impact on financial markets as a consequence, and let's start there. From their peak in late February through to late March, the Australian share market saw a 35% fall in prices. That fall in prices over a month is as fast as we've ever seen in history, except for the 1987 share market crash. Faster than the GFC, faster than the tech bubble in 2001. Right? These are genuinely unprecedented moves in markets. And the bounce since the lows in late March, 20% here in Australia, is also the fastest 20% bounce in such a drawdown period. These are very scary times for people. It's also had a direct impact on other financial markets. Cash rates in Australia are now 0.25%. We've never seen that rate before. Bond yields here are less than 1% per annum. I'm old enough to remember when 10-year government bonds yielded almost 18% per annum in Australia. The Australian dollar's been down to 55 cents against the US dollar, and that's a rate that we haven't seen for almost 20 years. So the big question is, what does this mean for your account balance? That is a great question. Now, I bet that everyone watching tonight would agree that it doesn't feel like that, but almost all of our diversified options are close to break even for the financial year to date, and I think that's an amazing statistic. If I look at our flagship option, MySuper under 75, we're down 2.2% to the close of business on Friday, 17th of April. That's an amazing number given the fall that we've seen in share markets. The other diversified options, such as Aggressive's down about 3% for the financial year to date. If I look at our defensive option, the least risky of those diversifieds, that's up 1% for financial year to date. For folks in the pension phase of the fund, your returns are similar to that, but slightly higher. It is an amazing thing to contemplate that after such a large fall in share markets and a bounce back, most of our options are down only a small amount for the financial year to date. And it's for this reason that we urge members to do two things. First of all, try and keep your eyes on the long-term return. I know it's very hard to do when daily news blasts come at you talking about share market crashes, but the longer a time frame that you can provide to any investment strategy, the more likely it is that that investment strategy will work. If I look over the last 4 years, for example, on our MySuper under 75 option, that's achieved a cumulative return of almost 34%. That's about 8% per annum. That's an excellent outcome. Other options have similar returns scaled up and down by their level of risk. Right? The longer a time frame you can provide for any investment strategy to work, the more likely it is to work. Members often ask us, how are we doing relative to other funds? And that's another excellent question. Well, I'm very happy to report to you this evening that LGIAsuper is doing as well as any other fund out there in these unprecedented times. We look at the MySuper survey in super ratings and categories for our other diversified options. LGIAsuper is doing well financial year to date. MySuper is 4th out of 50 funds. Diversified growth is 6th out of 50 funds. Our aggressive option is 4th. Balanced is the #1 option in the country. Stable is 4th out of 50. And the defensive is 1st out of 25. So this is the financial year to date to 31 March 2020. So LGIAsuper members are doing as well as anyone else out there in terms of returns during these times. But we're also happy with some of our other options as well, the fixed interest and cash options in particular. In fixed interest, we've kept these to be very plain vanilla, and the fixed interest option is now the #2 returner for the financial year to date. Funds out there have taken on risky credit securities in their cash options, have also potentially placed members' returns at risk. We don't do that here at LGIAsuper. Our cash option is fit for purpose and true to label. Plain vanilla cash. The team has been very busy in this time period preparing for tougher times ahead, but I'll be very honest here. No one in the team has forecast the coronavirus or the crash in share markets that we saw in late February or early March. I don't believe that sort of forecasting is possible, but I can tell you about our longer term plans. And it's just very fortunate that those longer term plans were helpful during this time period. We began selling shares here in late December and early January. we saw share prices having risen too fast compared to the prospects for corporate earnings. We also moved early to sell some bonds in the portfolio. Bonds have been rising in price as yields have been falling. We also went hard and we went early on raising cash, and this has been our most successful move in the portfolio from two perspectives. One is that cash retains its stable earnings over periods like this, but it's never been more important to manage the liquidity in a fund such as LGIAsuper. We want to give members the confidence that if they wish to switch or they wish to withdraw money, your money here is safe and it's available to you as and when you need it. The number one job for every investment team in the country is to manage liquidity risk, and I think we're doing an excellent job of that in the fund. So how are we currently positioned? Again, an excellent question. The fund has always had an overweight position in international shares compared to the domestic share market. And that's been performing very well for us in recent times, both from the perspective of the local share markets in the US, but also the exchange rate. The Australian dollar, as you know, has fallen quite a lot in the last 3 months. Share markets domestically have been badly beaten up, the banks in particular, but also certain resources stocks. You can only look at the oil price to understand what's happening there. It's time to bring some of that money home. So we've been gradually selling down our international portfolio, including some of the emerging markets, and bringing that money back into the Australian share market. We've continued to sell bonds. Bond prices are now very high and their expected returns are very low. If I look at cash, for example, at 0.25% per annum, our inflation rate is running at more than 1.5% per annum. Owning cash in the long term is going to earn you a negative real return. The same applies for bonds. Bond yields here in Australia, perhaps 0.8% for a 10-year government bond. These things are not going to generate the returns that our members need to establish their long-term retirement plans. We've also sold down a small amount of our global real estate investment trusts and our global listed infrastructure shares, and they've done excellently in the last 3 to 4 years. We continue to build liquidity in the fund. And the reason we continue to build liquidity is that we're looking at some of the excellent investment opportunities that are now being presented to us after this collapse in share prices. One of the great benefits, therefore, of managing liquidity is that it's not simply a defensive positioning, but it does give you the chance to reassess opportunities as they arise in these unprecedented times. A reasonable question for everyone to ask, therefore, is what can I expect from here? Have we seen the lows in share prices? And again, I want to be very honest with members. If I could tell you whether the low was in for share prices or not, I simply wouldn't be working here. Anyone who can tell you that they understand the financial market implications of a global pandemic and what it means for long-term earning prospects and the multiples that members should apply to that, you should have some skepticism about that confidence. We will get through COVID-19. Right? Life will certainly go on and financial markets will recover. The big question that we're focused on here is what happens next? As the economy begins to reopen and businesses again to operate, what happens in the long term? And that's the crucial question for all risk assets. Right? And the key challenge for us here is that as we headed into the COVID-19 crisis, share prices were already quite high. The prices paid for $1 of earnings were at close to record levels. And if we look at what share markets have done since that point in time, the bounce back simply has overcompensated markets for what we see as reasonable estimates of the fall in corporate earnings over the next 12 months. We also have this great challenge of very low cash rates and bond yields. We have an exchange rate in Australia that has fluctuated wildly in the last 3 months. But there are some prospects ahead that we're quite excited about at the same time. Australia is perhaps as well presented as any place on the planet to deal with COVID-19 challenges, both from a health perspective, economically and fiscally. We have relatively low government debt to GDP ratios here. We're also very linked into the Chinese economy. So given that China seems to have emerged quite quickly from COVID-19, if the Chinese government chooses to stimulate the economy, Australia is ideally positioned to benefit from that stimulus. Now that's not to say that there won't be further challenges ahead. Australia is heavily reliant upon our export markets, not just in minerals, but of course, but tourism and education as well, and that's heavily influenced by Chinese and Indian students. Right? We will have further challenges ahead. The one thing you can be confident of is that market volatility will stay relatively high. It's certainly quieter now than what it was a month ago. Share markets don't normally move up and down 7% in a day. I can remember when Lehman Brothers, a famous investment bank in the US, collapsed during the global financial crisis. The S&P 500 index was down 4.4% that day. We've seen moves of 4.4% or greater more than half a dozen times in the space of 1 month, often on consecutive days in different directions. That market volatility is very frightening for members. It's frightening for 30-year investment professionals as well. So we urge members, as always, to focus when they can on the long-term prospects for their superannuation. We urge members to ask questions. Information is the best source that you have for making better investment decisions and better decisions about your own prospects as well. We certainly want members to reach out and ask anything they would like about the portfolios that we hold and the actions that we're taking on your behalf. As always, LGIAsuper will be here to help you through these times and beyond. And I simply wanted to say thank you for your time this evening, and I look forward to taking your questions.